Most people think silver is a small market, just coins, bars, and a few investors stacking metal. But behind the scenes, something much larger exists, a financial structure worth more than $17 trillion. And almost nobody talks about it. Because once you understand it, the silver market stops looking simple. It starts looking fragile. Not fragile because silver is weak, but because the system around it is heavily leveraged. Let's slow down for a moment. The physical silver market itself is not $17 trillion. The real metal above ground is much smaller. What creates the giant number is derivatives, futures contracts, options, swaps. Financial instruments that allow traders to control large amounts of silver without owning it. These instruments create exposure. Exposure multiplies size. A single ounce of real silver can be referenced by dozens of paper contracts. That's where the scale begins to grow. Now imagine a tower built on top of that structure. Every layer representing another bet on silver's future price. Hedge funds making directional trades. Banks hedging risk. Speculators chasing momentum. Algorithms reacting to micro moves. Individually, none of this seems dangerous, but collectively, it creates something massive. A derivatives ecosystem that dwarfs the underlying physical market. And that's where the $17 trillion estimate comes from. Now, here's the part that should make you pause. Derivatives themselves aren't evil, they're tools. Used correctly, they provide liquidity and help markets function. But tools become dangerous when leverage expands faster than the asset beneath them. Because leverage introduces fragility. Imagine a building supported by thin columns. As long as pressure stays stable, the structure stands. But if pressure suddenly shifts, those columns face enormous stress. That's how leveraged markets behave. Stability most of the time, violence during stress. And silver has experienced those stress moments before. Sudden drops, sudden spikes, unexplained volatility. Most people blame speculation. Some blame manipulation. But the deeper explanation often sits inside the structure itself. Leverage amplifying normal price movement into extreme events. Now think about what happens during margin pressure. When price moves sharply, traders using leverage must post more collateral. If they can't, positions are closed automatically. That's called forced liquidation. Forced liquidation creates selling. Selling creates more price movement. More movement creates more margin pressure. And the cycle feeds itself. This is how billions can disappear quickly, sometimes even faster than investors can react. But here's where the silver market becomes unique, because while derivatives explode in size, the physical supply doesn't grow nearly as fast. Mines can't double production overnight. Industrial demand doesn't suddenly vanish. Silver is embedded in solar panels, electronics, and data infrastructure. It's not just a financial asset, so the underlying demand base continues operating, even while financial exposure expands dramatically above it. That mismatch is what creates a systemic tension. A small physical market supporting a gigantic financial structure. Now, most of the time, this tension remains invisible because contracts roll forward. Traders close positions. New traders open new ones. Delivery rarely happens at large scale. The system resets and continues. But the risk appears when behavior changes. When more participants demand delivery instead of rolling contracts. Or when liquidity dries up during volatility. Suddenly, the paper tower feels unstable. Now I want you to imagine something. A moment when volatility spikes while leverage remains high. Funds begin cutting exposure. Algorithms accelerate the move. Stops get triggered. Margin calls cascade. Suddenly, that enormous derivatives structure begins shrinking rapidly, not by choice, but by force. And when large structures shrink violently, price swings can become historic. Not because silver changed overnight, but because the financial structure around it was too large, too leveraged. This is why some analysts call it a time bomb. Not because explosion is guaranteed, but because the system carries hidden pressure. Pressure that builds quietly over time and releases suddenly during stress. Now here's the question very few investors ask. If the derivatives structure is $17 trillion, what happens if even a small percentage of that exposure unwinds simultaneously? That's not a prediction, it's a structural scenario. Because in markets built on leverage, stability is common, but stability can break faster than people expect. And when it does, the narrative changes overnight. What looked calm suddenly looks fragile. That's why understanding structure matters more than watching price alone. Price shows the result. Structure reveals the risk. But the real story gets even deeper. Because derivatives don't exist in isolation. They interact with vault inventories, delivery obligations, and physical demand. And that interaction creates the next layer of the puzzle. Before we go there, I want you to hear your perspective. Do you believe the derivatives structure actually stabilizes silver markets? Or do you think it increases the risk of extreme volatility? Comment stable if you think derivatives help the system. Comment risk if you believe leverage makes the system fragile. In part 2, we're going to examine what happens if physical demand starts colliding with that massive derivative structure. And that's where the story becomes far more interesting.